Okay, live Q&A and speed investing. Any ticker symbol you want me to look at or any questions you have over the last 30 days or something I did in a podcast that you want to ask, I'm going to go ahead and just look over to my other screen, and I'm going to mix this in with speed investing and live Q&A, so it kind of, it mixes it up a little bit. So let me jump back to price charts. So one of the questions that came in was, what is the trigger to get back into gold or GDX? And I think big picture, the trigger is gold at $1,000 and then wait for the correction or wait for a clean out. One thing we have not had in this secular bull market in gold is we have not had any sort of capitulation where there's just no bid, no one wants to buy, everyone's selling, the last remaining people who've been hanging on have given up. We have not had that. That started, let me just bring up GLD. That started back here in April of 2013 where gold just aptly started falling, but then it was arrested and stopped. If this fall back in 2013 would have gone on another week or two, maybe 2 more weeks and dropped down to here, that would have been that capitulation, but it stopped. And so we're really looking for that. And every major secular bull market in physical assets has had that capitulation. I held out hope that we wouldn't have it this time because it was so strong, and that instead of a capitulation and just a 2 to 3 week just rut and just everything falling, no bid, no one wants to buy, only people want to sell, I was hoping we'd have a sideways just bore people, get people out of it, but actually don't think that is going to happen, and we're going to have a capitulation, which for right now looks like it's going to happen somewhere around $1,000. Another question came in. Robert asked, why do the year-to-date returns, why do you not have year-to-date returns on the obvious trend? I do. I show them each month in the monthly gathering. I have to look on the portfolio page on the site. It's not as easy to keep that updated with the past returns, but whenever I show you the year-to-date return for obvious trend or any of the other strategies that I follow, those are year-to-date returns. Okay, let's see. If the euro bottoms, should we get out of EUO? So EUO is a 2x inverse fund. So basically it's the dollar going up. If the dollar is going up, this goes up twice as fast. And I actually played the euro with my clients and we made a quick 20%. And I just got out at this resistance. Clearly it has moved higher. Clearly it has moved higher. If we zoom out and look at EUO, the next major resistance for EUO is way up here at $23. So there's probably another 15% on the upside of EUO. The question is, if the euro bottom, should we get out? If I pull up the euro here, they're not exactly, EUO is not the inverse of FXE. EUO is actually, it gets influenced, I'm confusing you. It gets influenced by the dollar and by the euro, even though it's called EUO. So there's 2 things you could do. If you're in EUO, your next major resistance is up here. And let me just zoom into that. And that would up here. And that's not that far away. That's about 12% away. That would be your sign to get out. You could also do FXE. My suggestion is probably to stay with what's going on with the actual price chart of what you own, which is right there. How do we benefit from the yen movement? You can do a couple things. First of all, when Japan prints, almost all stock markets go up. The S&P is going up when the yen prints. You can buy a ticker symbol called YCS, which moves in the opposite direction of the yen. So as the yen devalues, YCS goes higher. So this is a way, and if I zoom out, you can see that the yen actually didn't do much in 2014 this year, but then right here around September, it has just moved up, or in the yen case, moved down, but YCS moves up. The other way you can benefit from the yen getting destroyed is by buying the Japanese stock market, but you have to hedge the yen correction. So you want to buy the Japanese stock market in yen and not dollars. And the easiest way to do that is to buy the ticker symbol DXJ. And that DXJ buys the Japanese stock market. And if you zoom out and look at this price chart, let me get rid of that. You can see when the Japanese government came out and said, we're going to destroy our currency, DXG has gone from about $32 up to $54 over the last 2 years, which is 70%. So that would be a way that you could get exposure to that. Okay, let's look at some stocks for speed investing. Whole Foods Market. I actually own this for my money management clients. I've owned it for 4 months, and for 4 months it has done absolutely nothing. I talked about Whole Foods in a weekend podcast, talking about how this company is not going anywhere. It did exactly what Apple did. It fell 43%. It's a $14 billion company. It employs, I'm going from memory here, 50,000 employees. This company's not going anywhere. It doesn't matter why it fell. It fell. All major companies fall at one point or another and scare people. But so I got into this with my money management clients, and basically for 4 months, just, I'm like, all right, it's not doing anything. It's not breaking up. It's not breaking down. And that's one of the things you want to see. Like, even when there's bad news and the stock market fell, when the stock market fell, it never broke below. It just stayed in its channel. And that's what's going on with eBay right now. eBay is just in its channel. I'm sure it's annoying a lot of people. And everything I believe to be true about price charts and how these price charts work and what they can tell us is eBay is going to break out into the upside. And it's been coiling and just waiting for some silly piece of news to come out. Either someone's going to buy something, someone's going to sell something, they're going to split their shares. It's going to be some sort of silly piece of news, and then it's going to move upward. And that's what's happened with Whole Foods. Over the last 4 days, Whole Foods is up about 20%. This is over the last week. Whole Foods is up about 20%. This is a really zoomed out weekly chart going back 7 years. If you don't own Whole Foods right now, you kind of miss the correction. If you bought it when you saw that weekend podcast I had on Whole Foods, it was either a podcast or a monthly webinar that I put on, then, congratulations, and just keep your stop loss on it. Next one is Google. Google, huge $370 billion company, does not believe in giving a dividend. So far, they've been able to get away with that. For this year, Google has underperformed. If we zoom out and look, it has done really well since the bottoming in 2008. In fact, look at this. It bottomed in 08 and not 09, which kind of told you how strong that was. But since that bottoming, Google's up 300%. Not bad. Not incredibly amazing considering the stock market itself is up almost 200% during that same time period. But what's interesting right now with Google is it hasn't really gone anywhere this year. If you look at what it's done this year, it's basically flat. Not basically, it is flat. It hasn't gone up, it hasn't gone down. It's in a sideways channel. For obvious trend positions, I don't like buying things that are going sideways, generally speaking, unless they are going sideways on top of major support. This is going sideways in a big uptrend, so it's less concerning to me. And they definitely can move higher, even though it's a massive company at $370 billion. It could be a $500 billion company. You could see 20% increase on this. If you own it, keep it. Keep your trailing stop loss. If you don't, I think there's better things to buy that have corrected. UEC is a uranium mining company, a teeny tiny one. $100 million. I mean, this thing, the CEO sneezes and the stock can go up or down. Uranium is up about 40% over the last couple weeks, maybe the last month, and clearly you've seen that here. As far as trading or investing in something like this, it is so volatile. There's almost no rules in stocks under $1 billion because they're so small. This stock's under $100 million. So, from a technical point of view, I just see a very volatile stock that, generally speaking, has been trending down. That downward trend, even with the big move up lately, really hasn't changed. I guess just now it's broken above that trend line. I'm just doing this live. So it has broken the downward trend line, so that's good. The problem with this is even if you have a 25% stop loss, it's not enough because each one of these lines is about 20% away from the next horizontal line. So this would be a really tough one. If you do own it, the big uranium company is Cameco, and that has had a big move up. And if you look at Cameco, which is a much bigger company, in relative speaking to the one I just showed you, this is a $6.6 billion company, which is still pretty small. But you can see this one has been kind of going sideways and nowhere for about a decade. So if you're not in it, I guess it'd be more of a skip. Okay, let's do a couple more speed investing ticker symbols. BG, FV. Okay, let me zoom in. Okay, what is this one? Big Five Sporting Goods, $230 million market cap, of almost a 4% yield. Well, it's way too small for me. It's going in the wrong direction. Clearly, it bottomed at $9, and it's up about 36% over the last 6 weeks. From a technical point of view, I would skip it if you already own it. Let's just see what these nice little... Oh, there's a nice little trend line there. What's the other trend line? So I'm just zooming way out to see what we got here. It's in consolidation. If you look on the screen, it's consolidating. The lows, the major lows on this weekly chart, back here in 08, 2011, 2012, and 2014, those are going higher, but there's too much unknown with this, and I would actually stay out of it. Let's see, next one. What is this? BGG. BGG, Diversified Machinery, $900 million. I don't like it. It's going sideways, even though I'm looking at a weekly chart. I do not like buying sideways charts. I would skip it. If you do own it, just keep your trailing stop loss on it. Federal Signal. I mean, I see this. I see this kind of this resistance right here. So that's the first thing. It's looking like it might be near some highs. If you don't own it, I would not buy it because it's near a resistance. If you do own it, of course, keep your trailing stop loss. I don't like to be in companies under $1 billion, and this is an $800 million. So I don't like the volatility of it. Clearly, it has moved up very nicely, about 35% over the last 6 weeks. So that's been nice. But when you zoom out, I don't like smaller stocks are so volatile. Clearly, 2011 at $3 up to here, that nice 400% increase has been great. But then this volatility, it's not just sideways, but huge amount of volatility sideways. That's why I do my best to stick with larger corporations where the volatility is lower. Here's the Realty Income Corp company. They call this what's their tagline? They actually have a trademark called the Income Company. It's a REIT. It's retail. It has almost a 5% dividend yield on it. It's $10 billion in size. It's been around for some time. We've owned O in the past. It's trending up. It's got a yield. As long as as long as the U.S. has ZIRP, zero interest rate policy, this is going to do generally well. And for a REIT that is yielding 5%, it looks nice. So that's kind of fundamental. Technically, it is slightly trending up on this screen. This goes back about 18 months. But still, a lot of volatility to get that 5% yield. VKQ has much less volatility to get a 6.6% yield. TSCO, we bought this. We clearly bought it too early. We did not let it correct enough. I've made that adjustment to add positions to OT that have fallen at least 20%. We bought it when it fell this correct, which was a beautiful correction here. It did a beautiful correction, and then moved back up. And this really was the beautiful correction here. We would not have been kicked out here if we would have actually bought it here. But how do I like it today? You know, what I don't like about it, let me zoom out. It did its nice, beautiful correction and scared people out of it, okay? And it has moved up so far, so fast that if you don't own it, 29%, a lot of the move has already been put into it. If you do own it, congratulations, that's a nice one. And retail is doing well. It's almost a $10 billion company, and I think it will continue to do well. Okay, last ticker symbol, then we are going to hit, or I'm going to hit the pause button. This is Fifth Street Finance. It's a $1 billion company. It's paying a huge yield. The problem, and we're looking at a daily chart here. I almost want to say it's a weekly chart, but it's actually only a daily chart. It does not trade that much. It is moving in the wrong direction. A yield, this stock is down 20%. A 11% yield can make up for some of that, but you generally want to find something that is at least going sideways and not down if you're going to get the yield. And that's what we have with Annaly. At least Annaly is going sideways for just about the same yield. I mean, we're up from a capital gains of 4%. But you want something to be trending up. So I actually don't like FSC because it is trending in the wrong direction. And I don't know where it's going to stop trending. Maybe it did this double bottom here and here. That could have been it. But again, why buy something that is trending down for an 11% yield when you can find something that is going sideways or slightly up? And the reason is you wouldn't. So that's what you want to do. Okay, guys, that was live Q&A. Any questions you typed in, I answered them. Anything that people emailed in, I answered them, and I took your ticker symbols too. Our next monthly strategy gathering is December 9th, 11 a.m. We will stream it. I will stream it live. And of course, you'll get my weekend podcast between there and any alerts that happen for any of these strategies that we're following. If any of you have any interest or curiosity in having, just looking into the conversation of having me manage your money, that's a really easy and simple process. You can just email Patty, Patty, at Fearless Wealth and say, hey, hey Patty, what's the deal? What's the deal with this? What does that look like? And you can speak with her about that. You guys take care. You'll hear from me this weekend on my podcast, and I will speak to you then. Take care.